All right, so I said I would cover high probability or what makes order blocks trustworthy. That was the framework that is like a bunch of you all got together and said, hey, let's all ask. And it was the 2021 group. The new members just joined this year in the last group. A lot of you are asking, what makes it trustworthy for an order block? And before I get into it, let me preface it by saying I know really what you're asking because it was what I was looking for years, which is unicorn trading. And unicorn trading is never losing, always winning. Unfortunately, I don't have a silver bullet for that. Okay, I don't know how to fix that desire for you because I never was able to fix it for me. I just grew complacent with the amount of trades that are able to be found with the rules I'm going to give you here. Now, this is a simple framework that can be utilized on all time frames, but the higher time frame order flow, if it's in sync with it, what do I mean by that? If higher time frame order flow on the monthly or weekly or daily is bullish, then what I'm going to outline here isn't going to be as trustworthy for bearish order blocks. Okay. Now, there are times when the higher time frame order flow, which would be the monthly chart, the weekly chart, or the daily chart, if it is bullish and we are extremely overbought relative to its recent price action, not because of the indicators, but because we're really pressed up high into the range, once the market starts to break down, as I'll outline here, then you can trust the bearish order blocks a little bit more. But even in those instances, they could tend to fail because you may be interpreting and reading the market that's predominantly bullish. And again, I'm using this as a hypothetical example, that would lead to you placing too much trust on a bearish order block that may not be justified. Okay, so let's get into it and show you what I mean by it. All right, ideal situation is monthly, weekly, daily, any one of those, preferably the daily, because that's the operable time frame for interbank. So we're looking at a market that's bearish. Okay, what does that mean? We're looking for something on that daily chart that suggests that the market will trade down to this level. What is this level? Notice there's no price axis over here and there's no time axis because I don't want you thinking that this is limited to any one particular time frame. But the daily order flow is paramount. That's paramount because if you don't have that established, I know what you're going to be thinking now is after this video, you're going to be like, okay, now teach us how to give flawless daily bullish or bearish order flow. And that's essentially that's the order of mentorship, core content, and then getting in the charter because that's what it takes to know it. It isn't one video I can teach it to you. It's lots of things that work together in concert. And that's why it takes a lot of study to understand how I trade and why the markets trade the way they do. It's not easy, but once you understand it, it's easy. So it's kind of like an oxymoron. One thing builds upon another, and you'll understand more. But let me strip it down to this bare essentials. Let's assume that this is the gold market. Okay, we don't necessarily need to be in a Forex pair, but let's just say it's gold. And you arrived at your analysis that you think whatever this area is down here, that price is the target at which gold should eventually trade to. How much time will it take to get there? You don't know. I don't know. But this is where the draw on liquidity is. Okay? And let's assume that you're watching price about there. And all of this hasn't happened yet. I'm giving you this diagram all in one completed perspective. It's crude, but it'll still accomplish the method. But we've seen some willingness to want to sell off. Well, how do we see that? We see a short-term high, and then it rallies higher than the previous high, and then it breaks down, taking out that short-term low. So you know what that is. It's a breaker, bearish breaker, And then here you have it. Once this is established, so you have a high, low, higher high, and the low is taken out. What this establishes on the near term is you have entered a sell program. The market is underlyingly bearish. So now at that moment right here, every up close candle, consider that a bearish order block until the market trades to the draw on liquidity, whatever that target is you think it's going to reach for. Now, what could it be? It could be like an old low for sell side liquidity, or it could be a imbalance that it's going back down into, like an old buy side imbalance, sell side efficiency, or it could be an old higher time frame order block that it's likely to trade down into. It's all based on whatever the market is showing you at the time, because not every PD array is available in every market environment. Depending upon what your structure is and the market you're looking at, you may not have any fair value gaps. You may not have any volume imbalances. Okay? So you have to go through the PD array matrix to see which ones are in that present market structure that would be somewhere over here in the left side of the chart that would not be here. I'm just focusing on what makes the order block trustworthy. Okay? Higher time frame order flow is bearish. We have a break in the market structure. How do we have that? The low's taken out here. All it has to do is trade below it one little tick. Once it does that, it doesn't need to close there. Okay? A lot of you see many people on YouTube talking about how market structures breaking right here, and I'm looking back at an older short-term low that broke, which tipped me off, or would have tipped me off, that market structure is bearish. But they're looking for the obvious things, okay? But for the lay audience that just came in 2021, you're going to learn that if you use this structure, okay, or template, or perspective, you're going to find that the bearish order blocks in this model of reading price are going to be highly effective. Now, it's not to say that you're not going to get into a trade idea and it trades through the order block. That would be a losing trade. If you get stopped out, that's a losing trade. Don't stir the water up so much with your inquisitive mind seeking more information and more detail, thinking that it's going to eliminate losses, because I cannot eliminate losses for you. I have yet to figure that out for myself. So that's a unicorn. We don't trade unicorns. So the break in the market structure here, once that comes back up and hits the breaker, once it hits that and starts to sell off, your mindset is, okay, here's where it's going to draw to next. So as it's drawing down, once it breaks this low here, once that occurs, is there a up close candle somewhere in here or in here in this price swing up that it may revisit? So don't think that price is going to move in straight lines like this, but overall, and I'll show you an example before we get out of this line perspective, but I want you to think in terms of price swings. But once we get below this low here, always anticipate the likelihood of the market wanting to reach back up in, because they may not have been able to position enough shorts on. So the algorithm will likely, not always, reprice higher up into a bullish candle, either in this swing or over here. And this is why it's not supply and demand, because we cut through candles. But once this breaker starts to deliver downside momentum, even before it takes out this low, every up close candle, in my mind, is a likely bearish order block. It's further increased in its likelihood if there is a fair value gap associated with it. Another one is if we had inside this price swing here, say it went high and then higher to make this high, okay? That would be a run on stops, and then it breaks lower. Then I really like every up close candles after that, because we had a stop run, and then it should accelerate before we get to about halfway point from wherever the breaker is and wherever the target on the drawn liquidity is. Because then you got to go into grading your price swings, which I teach you also in the mentorship. And a lot of these things that are not going to be fully explained to your liking and satisfaction will be amplified and taught more clearly when you go into the lesson grading price swings. Okay, so the movement lower here, every up close candle in this swing here is a likely bearish order block. But if it's not traded up into during a kill zone, in other words, it must be traded up into during a kill zone for it to be a valid bearish order block. And it's further valid, okay, or more trustworthy, quote unquote, if it is associated with a fair value gap as well. And then the market has a small little consolidation and rallies back higher again. And the next idea would be look for this low to be taken out. And as it breaks through it, right in here, you have to revisit this range or this range where there may be an up close candle that may be revisited as a bearish order block, because we cut through candles. We're not looking at just a fresh zone. There's no such thing as a fresh anything. Okay, that idea is cartoonish to me, and not because it's a opposing theory, which is flawed by many ways. It's just because it's nonsense. Okay, I've proven beyond a shadow of a doubt that the algorithm will revisit certain things in price, and I've illustrated it before the fact. I've even illustrated where it's going to do it, why it's going to do it, and we were cutting through all kinds of candles to get to it. So, Online Trading Academy, and Sam Seiden, and all the folks that subscribe to that stuff that he's marketed as supply and demand, those things, okay, they're a facade. What you need to know is this. Where is the market likely to go to? Because if you don't have that, everything you're learning here, everything you'll try to do outside of what I teach is going to fail. Now, I'm not saying you can't get lucky once in a while, because even I got lucky in the beginning, 9 months. I had no idea what I was doing. Way back in the 90s, I had no idea what I was doing. But everything became easier, and my strike rate was improving once I learned to focus on where it's likely to go. Because once that happens, you can almost see how the price swings are setting themselves up just to re-enter an area that's a short-term overbought and then sell off into the target. But as we move closer to this objective, every up-close candle becomes less likely, because there's no need for the algorithm to reprice when it's this close. For instance, like if we're down here, there's no reason for the market to go back up into some kind of a up-close candle for bearish order block to be revisited to go down here. It's going to be in a hurry in this leg, so it's not going to be trying to find an order block. Up here, about 50% of the price leg from this short-term high to down here, this is going to be real high probability. This is really high probability as well, but it requires a lot more analysis. This one here, when you know what it's reaching for, this is the easiest. In other words, what I'm outlining here, and for some of you that are in the 2021 group, you're looking at this saying, this is too simplified. I don't know what you mean. I don't know what you mean. Trust me. I'm going to show you an example. We used it in real time, but I'm going to show you what I mean. Getting rich, okay, getting wealthy, getting to the point where you don't need to work anymore and you can find enough trades in the marketplace to fund yourself and your lifestyle, whatever that lifestyle is, fill in the blank. It's going to be seen with these trades right there. When you have all the backdrop over here in a bearish market, these are the easy taking candy from a baby type trades. And most of the time, when I was doing examples on Twitter, unless I was showing my algorithm without teaching it and showing off, I was doing a lot of these types of trades, or vice versa when it's bullish. And we'll see a bullish example before I close the video. But these ideas of knowing where it's likely to go and not making a big deal about all this, because this is where all the trolls would say, yeah, but he didn't sell it there, but he didn't sell it there. and he didn't sell it somewhere in here, I'm selling it in here. But they don't know what I was doing back here. I'm just choosing this as an example. And when I was on baby pips, these are the examples I was showing also, where they're just easy over and over again. And I wanted to see if folks would pick up on it. Nobody was picking up on any of it. Like, I felt like I was a Martian visiting Earth. Everything I said, no one could understand. But anyway, the point is, this area here is the highest probability shorts for bearish order blocks, because it's in a hurry to get down here. You know it's likely to go down there. And it might be relatively equal lows way back over here. And or it might be a single low that it's going to try to race to get down below. But this right in here, this peak is going to have the highest, most trustworthy bearish order blocks you'll ever find in your life. If you learn to wait for those types of setups on all time frames, this could be a 5-minute chart, this could be a 15-minute chart, an hourly chart, a 4-hour chart, a daily chart, a weekly chart, 3-month chart, a 5-hour chart, whatever time frame, it doesn't matter. But you need to know what's in this green box. That's the draw on liquidity. That's where the algorithm is going to be repricing. Because if you don't know that, everything else, every PD array is going to fail you, because you don't know where it's trying to go to. If you know where it's likely to go to, given enough time studying the market like that, it makes it very clear to see every instrument I've taught you in PD arrays. You'll find the ones that exist in price, and you work with those. It's not like it's hidden, like they're hiding some fair value gap there you can't see. It's either there or it's not. It's either going to have an up close candle in this price leg or this price leg that's going to act as a bearish order block, or it's not. It's not hidden from you, is what I'm saying. And you're going to find that if you can just strip your trading down to the most obvious things, try not to make it seem so mystical, okay, or too high and lofty, or just overcomplicated. It may seem that way because I have a lot of things I've been teaching you, but not every price swing has every element that is available to the algorithm. The algorithm is going to see what price is done in the past, because it's done what it's done based on what it's delivered. So it's going to refer back to its own old work. Well, we know that those signatures in price, what do I mean by that? The specific PD arrays, the old high, the rejection block, if it's got a wick, the consequent encroachment of that wick, because we treat it as a gap. And then you have the bearish order block. And then you have potential bearish propulsion candle. Then you have a potential fair value gap in the form of a sell side imbalance, buy side inefficiency. And you have volume imbalances that can be anywhere in between the bearish order block low and the next short-term low. So I got a question about that, so I'm tossing that in there just as extra credit. Throwing that in there extra because I was asked, where does volume imbalances lie in the PD array matrix? It's anywhere between the order block, bearish order block's low, or above the bullish order block's high. It can be anywhere above that or below it relative to the order block. So the idea is you want to learn this right here. And also what you're looking at is this is the second half of a market maker sell model. So this is smart money reversal. Some low risk sells over here, maybe in this price leg. Then you have an area of distribution. And what happens next? The second level of distribution, where it's going to be in a rush to get down there. So that's why it's important, why I'm even teaching you the market maker sell model and buy model. And if you understand it, you literally can make your own paycheck, whatever you want it to be. You get out there and get funded and just turn yourself loose on the world. Okay? And just literally just destroy it. But you have to understand what sets this leg up. Because if you don't have this, well, you don't know if it's going to be in a rush to get down there. But if you have this one behind you, and you have the old high being taken over here, and it breaks down, you have all of the confirmation of a market maker sell model in play in an existing bearish market. So you have all of the advantages of knowing that there's going to be a bearish order block in this leg or here, that if you see it trade up into that, it's hammer time. And just watch it walk right on into your target. And many times it'll just overshoot that as well. what I'm showing you here is literally the Holy Grail. Like, this is the blueprint to millionaire status. And it's literally easy, but you have to learn a lot of things to get all this stuff understood. And I'm showing you a lot of things with just simply with this line chart. And I could teach this lesson just like this on YouTube, and it would fly over 90% of people's heads because they haven't been here. They haven't gone through learning everything I'm teaching you. But this right here, this is the money train. Like, this is the easy, absolutely, like, put it this way. The laziest of all the interbank traders wait for this one because it's the easiest one. It runs right to their targets real fast. It usually has very little, if no drawdown, no pullbacks, no retracements. It's just straight on right into money. Now, the problem with this is you're going to want to see this so frequently. You're going to look at every little short-term rally and think, yeah, I'm so impatient, I can't stand it. This is going to be that thing. I want it to be this type of event that ICT is talking about. But it may not really be there because you're too new. Your infancy as an analyst is going to cloud your mind, and your impatience as a trader and gambler is going to make you think you're seeing this. And then when it runs through your order block and hits your stop, you're going to assume that what I just taught you here is not true. But for those individuals that have gone through Charter 11, been here for years, this lesson in itself is gold. Like I'm telling you, this is the blueprint. This is the absolute easiest way to assure yourself that the bearish order blocks that you're going to trade into in here are going to be the very ones that you can trust. Everything I said, obviously, for the sake of brevity, can be reversed and placed in this diagram too. But the idea is we have a market that's underlyingly bullish, and we have a market that went low, lower, and then we traded higher. So we have a breaker. Once it hits this breaker and starts to trade higher, once that occurs, we don't need to see this high taken out. Once this starts to trade higher, we know that there is a strong potential for this to go up into a objective. And this is where we're looking for what? That draw on liquidity. Okay, now this is the buy side of the curve of a market maker buy model. So this whole element here is what we're looking for bullish order blocks. The highest probability, easiest bullish order blocks are going to be inside this leg here and in here. So in the market trades down in either some down close candle in this leg or in here. If it trades down into that, that will be a ideal bullish order block, and you can trust it because it's going to be in a rush to get up into your target level. So with that in mind, let's take a look at the euro dollar on a daily time frame. Now, obviously, if you've been here all year with me, you know that this is a market that we've been watching, and it's delivered, most of this stuff, what we were expecting. This old high draw on liquidity. It's also a market maker buy model. We have a low that gets taken out here. Then we trade above the high, which is the breaker. Notice this down close candle right here. Above the breaker. There. The market trades up and then down. Bullish order block. It trades to it here. Does it rally? Offer profitability? Yes. Then it starts to turn back down. Well, it didn't take out the high, Michael. Right. This order block allowed you to make this much profit. That's over 200 some pips. Take profits. And the market drifts back down. Well, it's revisiting this old order block. So that becomes a bullish reclaimed order block. Trades into that. You can buy that again and trust that it's not likely to go down. Why? Because it has the backdrop of the breaker as well. And at this moment here, the highest high has been only here since this low. So has it taken out the buy side liquidity resting above here yet? Once it moved from this high down here into the order block again? No, it hasn't gone above this high. So the draw on liquidity still stands. That's what this little shaded area is. All I'm doing is mimicking this idea here. So right in here, the market rallies again off the order block, trades up, and then what if you miss this one? And it starts to trade back down. Well, these two down close candles makes the bullish daily order block. Right there. Trades into it there. This is that easy trade. The easy one that is right in this leg here that leads to the promised land. Okay? The land of milk and honey. That's what we're looking for. That is seen right there. And look how it runs right up into the old high. Now, if you've never seen the market maker models, buy and sell models explained by me in mentorship and the teachings that go along with building all that out and fleshing it out, this would sound like, oh, all you're doing, Michael, is just looking at this example here in hindsight and you're matching it up. No. Go back through your lessons when you look at the market maker buy and sell models. Okay? Everything I'm teaching you here is covered there. And then you also incorporate grading your price swings and also incorporate how in this leg here, when I talk about advanced theory, you'll understand that there is no stop grades here. So that way you're not worrying about, as the market starts to trade back up, it's going to come down and jam out a stop. No, that's what it's done here. Short-term low, taking the stops. Rallies, the next touch in the order block, that's going to be dynamic. And we have it here. So I gave you a lot here, and obviously it's not a one-sentence answer that says, how do we know that we can trust the order block? You want a, oh, well, it's this, there it is, it's done in one sentence. And you've already learned, hopefully by now, that market mastery, understanding and unlocking what this algorithm does, is not going to be easy, which is the reason why I've always touted that I could put this on the front page of the USA Today and it would largely go ignored because it requires study. It requires testing the theory and looking at old examples. Now, here's how you learn how to find order blocks that you can trust. Everything I've outlined here, find it on any time frame. Look for market maker buy models and sell models, and then look for the order blocks in the last leg before it gets to a draw on liquidity. Now, you're probably going to say, well, what about these? Well, this is below the breaker, so there's really no necessity for it to come back down. In fact, you don't want it to come back far down. You want it to respect the breaker. And again, you're going to try to find the solution to why you're confused about what order block or what candle makes or constitutes an order block because you're so new. Like you've only been here for a couple months. So in the 2016 group felt the same way that you feel. And then the 2017 group, and then the 2018 group, 19, 20, and here you are, the last group. All of you have sent me this same email, okay? It's just that there's a whole lot more of you that came in on 2021 that are now asking the same question, which also gets answered actually by just simply going through the mentorship content. But it's in pieces, not because I'm trying to hide it, but it requires components that's taught in one lesson. And once you understand that, you're going to refer back to that same lesson. What lesson am I talking about? Grading price swings, market maker buy model, sell model, draws on liquidity, institutional order flow, the PD array matrix. All these things blend together to give you the understanding that you're looking for. But this is exactly why I can't. It's impossible. No one can teach it to you like these young guys think they can do over there on YouTube. All they're doing is demonstrating what's already happened in the past. They're never explaining in advance beforehand. Like when I give you commentaries, I'm telling you what I think is going to happen. I tell you what level's likely to be respected and what it's likely to do. That is mastery. That's someone that knows what they're talking about because I invented this stuff. Okay, it's mine. I coded it. How much more plain do I have to make it? If you see these things in hindsight, studying them, you'll understand more about what it is I'm showing you. I've gave you much more than simply giving you what makes the order block trustworthy. I gave you the blueprint. I gave you the very blueprint that puts profitability in your hands. If you look and you find the very things I've outlined here, you will have it. The problem is you have to learn to wait until that leg right here sets up before it runs that old high, because this is the draw on liquidity. Now, this is a daily time frame, so there's not going to be a whole lot of these types of setups. But man, oh man, do they set up a lot on 5 minutes and 15-minute charts every single week. And this could be your bread and butter, just simply looking for that. If you know what it's likely to draw up onto, like, take this D and change this whole time frame. Not that we can, because we're just using our imagination now for a hypothetical example. But let's assume this is a 15-minute time frame. Okay, 15-minute time frame. Each one of these candles represents 15-minute intervals. So if it's trading down to that order block here, from here to here, that would be your price run. And that's your bread and butter setup. That one's done. Then find another pair and look for something that's going to set up the same type of thing. On a 15 and 5-minute chart, there's lots of them all week long. From Monday to Friday, you get a handful of them each week. And you only need one of them to replace your job. But you have to grow into it. You all want Instagram overnight and rented cars. You got to slow down that stuff, because all that rushing and all that I need to know right now, you don't need to know right now. You need to study, because studying will show you what you need to learn more about. You think that the order block is all there is, like everybody on YouTube, order block, and everybody out there is teaching order blocks wrong. You have no idea what they're talking about. And the only time that they seem like they have it correct is when they're looking back in old data, saying, oh yeah, this one works. I'll talk about that one. Just listen to them when they talk. All right, let me see. Let me find a new order block. And all they're doing is looking for where it traded back down. That's not the same as understanding what's going to happen before it happens and trusting why it should respect it. I covered that here. And what I did not cover here, I promise you, folks, the videos are already in the core content. They're in there. Those lessons that you're asking for, they're in there. But what I wanted to teach you is a very small little way of using everything that you're given in the mentorship, finding a very simple one strategy that literally can deliver gangbusters, like puts wealth within your hands. And if you understand everything I've mentioned here on a basic level, market maker, buy model, sell model, understanding the draw and liquidity, what an order block is, this gives you a real quick way of reducing everything this 12-month core content basically drops in your lap and gives you one premise, one setup, that if you go in there looking for it, that's all you need. You don't need to worry about everything else. You don't need to worry about Artemis patterns. You don't need to worry about reflection patterns. Okay, you don't need to worry about optimal trade entry, this, that, other thing. None of that stuff, because you only need one thing out of everything I'm teaching you, and it's going to be something that you adopt. You find that is comfortable for you to see in the chart. It makes sense to you. There's so many times that students over the years have tried to form a model and put everything I've ever taught. And I'm still getting people, do you use the Trader's Trinity? No. Trader's Trinity was my infancy, but it led to me understanding grading price swings, understanding order flow, reading the tape, and understanding premium and discount in a more intimate level. Other than that, you don't need Trader's Trinity, and some of you probably know what that is. It's nothing. You don't even need to know what it is. Okay, it has absolutely no necessity on you being able to be good at this. But the point what I'm trying to say is that every group I've ever taken in for mentorship, there's always this huge underlying desire, this rush to to learn everything and then find how they can put it all into every market environment at all times. And that's not what I do. That's not what the algorithm does. All you're doing is finding something that sounds beautiful to you. It's like chords. Everything in music, you only have so many notes. But when you string certain notes together, they can make a beautiful chord. And or if you play a series of notes in a particular pattern, it comes across in a beautiful melody. And it's a matter of personal preference. I may hear something in a string of notes that may strike me as that's beautiful and that resonates with me. You may hear it and say, whatever. But then you play around with the notes and then you find something that sounds wonderful to you. That's what we're doing with reading price. It sounds as if something like this would be so impossible because the market's going to do what it's going to do, right? But you, as the person engaging with price, you're the trader, okay? The analyst has to be able to tell you where in your trading, where do you think this market's going to go? Once you have that, then it's a matter of, okay, down closed candles should act as springboards. Trampoline, okay? Now watch how many people in here that's doing mini mentorships are going to start calling these candles. These are trampoline candles. So they're going to drop down in here and it springs higher and it reaches the target. Well, I'm not bringing COT commitment traders into that. Notice that? I'm not bringing in rate differentials. I'm not bringing in moving averages. I'm not doing anything like that. All I'm doing is stripping it down because once you know what you're looking for, and this might not be the thing for you, but I promise you, some of you that are 2021 students that have studied my mentorship and have gone through at least the majority of the things I taught for free, and you're familiar with the models, the market maker sell models and buy models, what I'm showing you here is like, wow, yeah, I didn't think it would be that easy. Right. But it's always been that easy. And that's just why I tell every one of you that I'm not trying to press you into a mold. I could literally sit down and come up with a model every single day of the week. 365 models a year. Okay. Now, it doesn't mean that model is going to answer the riddle of the marketplace today, but you only need one model. And you need to know when it's likely to form and wait for that environment to present itself. If you work inside lower time frames, it will present itself multiple times per week. Every model. Every model on a lower time frame will present itself multiple times per week. That's the benefit and the power of me teaching you lower time frame trading. I know some of you don't want to day trade. I know some of you don't want to scalp, but it doesn't change the effective way of learning because you're seeing multiple examples and it's scalable. You can take the same thing you're seeing on the lower time frames, 5 and 15-minute charts, and assume it's a daily chart or an hourly chart or 4-hour chart, and you can swing trade, day trade, position trade, all of that the same way. You just aren't going to get as many setups, and it's going to require a great deal of patience. And the problem with long-term, higher time frame trading is if you miss it, you're going to have to wait a long time to get another one. Or use the lower time frame studies that I teach you to get in sync with the move that's already begun. See, there's a benefit to what I'm doing. It's not just simply, this is my forte, so therefore I'm only going to teach what I do the best in, because I can do any time frame. I just don't have the patience. I don't have the patience to sit in here and operate on a daily chart and just trade that, because there are so many price action moves inside of one daily candle that I'm gonna blow my brains out if I try to do that. There's no way I'm gonna do it. To me, I'm wasting the potential velocity that's available if I work with the lower time frames. The lower time frames are a gold mine. You know, it's to me, it just makes no sense why anybody wouldn't pursue it, because it's taking you closer to the marketplace. Dailies and 4-hour charts are just, they're too slow, way too slow. And I love seeing what the market's doing. I like how it breathes. I like how ebbs and flow. It's dynamic. And even when it sleeps and goes consolidated, it's still telling a story. And sometimes that story is long and boring and you don't want to hear it. I don't want to hear it sometimes. But I know it's leading up to something exciting. And that's what you have to wait for. But you have to identify some component in all the things you're learning here. And I introduce just subtle little ideas in the form of price action models when you're a charter member. They in themselves are not all there is. Like, you joined a community and you have access to me for life. As long as I have my mental faculties, innercircletrader@gmail.com will be your gateway to me. If you ever, have a discovery about something or whatever, you send it to that email, and it may take a long time. Obviously, there's nothing I can do about that because there's so many of you. But you have a way or bridge to me where the public won't do that. And a lot of people get mad that send emails to me, and I just don't have the time to answer them. And it sounds callous. It sounds insensitive. But my time is obligated to you. But I don't have the time to devote it to every single person that ever emails me. So what my staff does, they get a collection of emails that keep repeating, not the emails, but the themes that keep repeating, and they will send me a hit list. Say, hey, look, touch on these topics because they seem to be coming in a lot about this idea or this, shortcoming in their understanding, which is the reason why we touched on this tonight, which is, how to trust order blocks. And I wanted to go in and not just simply give you the common response I always do. It's, you learn how to do that by going through the core content, all 12 months and charter level. Once you get through all that, you'll know how to trust a order block. But the 2021 groups members that are asking this are so low in the core content, they haven't, even the ones that accelerated their payments and paid multiple monthly payments quickly to get to charter level, they're discovering that they still have to do a lot of the studying. Like, it didn't change you magically because now you are charter level because you paid faster. You just left a lot of work behind you that you got to go back through again. But all that content's available to you now. And now you can talk to people on the forum, and you can see there's other people in your group that are doing what you're doing, and some of them may have the same thoughts and concerns that you have, and others will come in and say, hey, I had that same thought, and now I don't have that anymore because I can do this and I can do that, and you can interact, and you can see how other students have taken what they have been exposed, just like you have, same content, but they have created something independent and unique for themselves. And there's nothing wrong with that. In fact, it's beautiful. But if you look at what this is here, this is the first accumulation. This is the second accumulation. First accumulation, second accumulation, runs to target. Second accumulation, runs to target. That's the algorithm. That's how I see. Remember the movie Matrix when Neo, Keanu Reeves' character in the movie, he could finally see what the Matrix was, and instead of what we see when we look around our environment, he started seeing ones and zeros. He saw the binary code. That's, when I look at price, I'm not looking at all the certain candlesticks, the patterns of the candlesticks like Steve Nielsen and those individuals. I'm reading price like I'm showing you here. It went down here for a reason, and now it's trading up. What's it going to reach for? There. You don't see that in trading books. I mean, you see it now because people are just taking what I've taught. But the point is, there's a logic that the market's going up here to take that liquidity out. It's going to those existing orders because the market has traded lower. Lots of traders are going to keep their stop up here because they don't want to do what? They don't want to get stopped out. And you would be surprised how many fund level traders do not want to trail stops. They don't. They live by deep pocket theory. And deep pocket theory is once they enter their initial risk, they hold that until it gets to 50% of their objective. Then they'll either take something off or they'll start to move their stop down. But they don't look at things like, okay, it started to go down here. So once it broke this level and went lower, they're not going to trail their stop loss there. And then once it trades lower here, they're not going to drop their stop loss from here to here to here. It's right here. Deep pocket theory is prevalent in large fund trading because their trend models are basic. They're very simple things. And they don't want to overcomplicate it because the customers don't want a lot of whipsaw. They don't want a lot of, back and forth. They just want to let the long-term positions go. And that's how they operate. It's a really simplistic way of doing it. And which is also why the interbank traders cannibalize them, because they're just easy pickings. And the only thing I've done by coming out is simply showing you how they cannibalize. But they also cannibalize on all these small little time frames because the algorithm will still operate on these lower time frames. Because those smaller little fluctuations that are occurring because of commerce that's coming into order flow all day long during the kill zones, that's what the algorithm's working with. It's working with the order flow that's coming in on commerce, not speculation. Up here, the stops up here, that's rooted in speculation. But intraday, during the kill zones, that is order flow associated with commerce. So we're working with that order flow that's being piped into the marketplace during specific key times of the day to have no real bearing on fund level up here or fund level down here. So hopefully this has got your gears turning. I'm sure it probably created all kinds of new questions, and that's wonderful for you, and that's what you're supposed to be writing in your study journal. In your study journal, you're going to write down the questions that you've been inspired to have now with this lesson, in this lecture, and you're going to pursue that by going through the mentorship core content and through Charter. That doesn't mean don't send me emails, but just know that 99.9% of the things that you're going to ask me are actually answered by simply going through the mentorship and going through the content and studying it and not watching the videos, 4 and 5 of them a day, just to go through them, binge watching. You got to really chew on them because there's a lot like this one. There's a lot of them that have deep, dense lessons in them, and you got to chew on them and really think about how this applies to what you've been experiencing or what you have yet to experience, but now you're concerned about because you didn't think about some of these issues that you're unaware that may be staring you in the face in the future. And what do I mean by that? You'll know when you get to those lessons in the core content. So anyway, this is something that if I was given this in the 90s, oh man, it would have been a whole lot easier. It would have been a whole lot easier. But, everybody has to endure, growing pains and such. And I want you to do well. And don't think that this is the only thing. This isn't the only trick to be profitable. But it is one of the easiest, absolute easiest things. And I literally do in-depth teaching on this whole thing right here when we get into price action models and looking at the market maker sell and buy models. Okay, that second level of reaccumulation in here, that is just, man, that is it. That's the I don't even know the word I'm looking for. It's escaping me. Like it's the lottery trade. Okay, it's the casino payout. It's the jackpot. It's what you're looking for, really. But you need to understand what makes that second level of reaccumulation before it gets to the draw and liquidity. You see, that's what makes this tricky. Because if you don't know all those other things, you're not going to know or anticipate when this is forming. So I'll just toss this in here as extra. When we have the market maker buy model and they have the original consolidation, they may only have one level of distribution, which is essentially what we have here. But on the market maker buy model, there's always going to be at least 2 reaccumulations. Why? This is so that interbank traders can't miss it. They can't miss it because they see this one and it starts to rally, but they still are aware that that order flows right in here in the form of buy-side liquidity. This just basically lays it in their lap. It's laid on a silver platter, neon sign. It's right here, boys. Come and get it. And then they serve it up to them.